All right, well, welcome everyone. Thank you for tuning in to another session. We're going to be talking about a concept that a lot of investors initially struggle to comprehend, and that is how debt is handled in the context of a DST. So we're going to be taking a deep dive into that. I am very pleased to be joined with Nick Snyder, one of our associate vice presidents here. So without further ado, Nick, welcome to the conversation and thanks for being here.
Yeah, thank you, Matt. Happy to be here.
Yeah, so let's dive in. I think a good place to start with this discussion is really understanding the IRS requirements as it relates to debt. So Nick, can you walk us through what the IRS cares about and what they want to see in a 1031 exchange and how that kind of spills over to a DST?
Yeah, of course. So the 1031 exchange, it requires you to buy the same amount of real estate as you had sold. So if you sell your property for, say, $1 million, you then have to go out and purchase $1 million worth of real estate. Now, if you're debt-free and you don't have any loans, it's very easy. You just use whatever money you have available to buy that amount of real estate. Now, where people get a little tripped up is when you have debt on the property. You know, say you sell your property for $1 million, but you have a $500,000 loan. You only have $500,000 to then reinvest back into real estate. So, you know, people are kind of sitting there asking, what do we do? A lot of the DSTs we have do have some set financing on the property that could then be assigned to you and allow you to cover that for the exchange so that you don't have any taxable loop.
Mm-hmm. Yeah, very well said. So a way that I like to describe it to investors is there's really two requirements that the IRS looks at. Mm-hmm. One, spend all the money.
Yep. Whatever
you receive in cash, reinvest that cash.
Yep.
And two, replace or exceed the total value of what you sold. Mm-hmm. So your example, you sell a building for $1 million, you have a loan of $500,000, you pay that off at closing, you have $500,000 of cash. The IRS wants to see you invest the $500,000 of cash and purchase property or properties for $1 million or more.
Yep.
In a traditional context, that would be the investor going to a bank, getting a loan, finding a property that they want to acquire that's worth at least $1 million or more. Mm-hmm. In the context of a DST, they're actually able to assume the in-place financing that is already structured into these investments. So let's dive into that in a little bit more detail. Nick, can you describe how the DSTs are initially structured by the sponsors as it relates to the debt and how that debt is ultimately assigned to investors?
Of course. So, you know, on the sponsor side of things, they go out and they look at hundreds of properties a year. So when they're looking to put up a DST, they'll go out and find a specific piece of property that they think would fit well in the DST structure. If they're looking to put a loan on it, they're the ones that actually go out, sign all the loan documents, get the institutional debt to then put onto the property. So they take a lot of the, heavy lifting off the table and do it themselves. When they then launch the DST, there's a set loan to value that is on that DST for typically the term of that property. So if they were to find something that was worth, say, $100 million, they could go out and get a loan for $30 million. They could then go get cash and cover that with $70 million worth of equity. And then at that point, they could then launch that DST as an investment for $100 million at a 30% loan to value.
Mm-hmm. Yeah, well said. So to use that example of, the $100 million property, sponsor company, they identify this, say it's a large, multi-family property in Texas. Mm-hmm. They get it under contract. They go through their whole due diligence process. And during that due diligence process, they will be talking to different lenders, right? Yeah. And they'll secure financing to aid in the initial acquisition of that property, just like you or I would do in our acquisition of a piece of our own property, right?
Yep.
So they'll get a loan in this example for, I'm just going to make it even simpler, say for $50 million, right? And so the lender comes to the table with the $50 million. The sponsor comes to the table with $50 million of cash. They close on that property. The sponsor will sign all the guarantees, all the carve-outs, et cetera. So it's the debt's set up on the institutional level, but then that DST gets launched to market, and the investors can come in on the equity side and be assigned their proportion of the debt that is already pre-structured into that investment. And some of the things that we really like about that is, one, as you mentioned, it's non-recourse, right? The investors don't have to, A, qualify for the debt, and B, they're not signing any guarantees, so the maximum exposure they have in that investment is the equity principal that they've contributed there. And then the second aspect of it is it's very easy for the investor to step into that financing and effectively replace the debt. A lot goes into a traditional acquisition as it relates to real estate. When you're operating in a short time frame, 45 days or the 180 days, and dealing with all your own due diligence and other curveballs that come up, the debt can unfortunately sink the ship for a lot of investors on the traditional side. So on the DST side, it's nice that debt's already there. It's already locked. It's already on the deal. And then it's just about matching the appropriate loan to value from what they sold to what they're buying. Can you talk maybe a little bit more about how that would work? Let's use the simple example of, the $100 million property. It's $50 million of equity and then $50 million of debt. How would that work for an investor that's, say, coming in with $100,000?
So it's actually quite simple. So if you put $100,000 into a DST at, say, that 50% loan to value, you actually end up buying $200,000 worth of real estate. So 100 of it is going to be your initial equity investment into the offering, and then 100, the difference is going to be the non-recourse loan that is assigned to you in the DST itself. So, if someone had sold for $200,000 and they only have $100,000 of equity, just put that into a DST at a 50% loan to value, and then you could qualify for that full tax deferral.
Yeah, well said. I think another way that I like to think about it too, and there's different ways that make sense to different investors. So I'm going to say the same thing you just said a couple different ways. So another way to think about it is if a DST has a 50% loan to value, that is the same thing as saying the investor is contributing a 50% down payment of their equity to acquire interest in that DST, right? Because 50% of their value is the debt that they're assuming. The other 50% is the cash that they're bringing to the table. So just like if you were to buy a house or another property and you were to come down with 50% of a down payment, it's the same concept as it relates mathematically to the DST. So your $100,000 in this example is your down payment. And the other 50% is the loan proceeds that you are assuming in the process, which leads to what you said, a $200,000 total position in that DST. I'm going to throw one more at you too. So if both of those don't make sense, another way that an investor can think about it is on a percentage ownership basis, right? So if an investor is coming in with, I'm just going to make the math really easy for myself, say $500,000 into this $100 million property. The $100 million property, as we talked about, it's broken up into $50 million of equity, $50 million of debt. So if you divide $500,000 of cash into $50 million of total equity in the offering, that's 1% ownership, right? So you own 1% of the equity. You would also automatically be assigned 1% of the debt, right? So you have 500 of equity, you have 1% of the debt, which is also 50 million, which is 500. You have a total position of $1 million in that DST, which is 1% of the total offering. So there's a number of different ways to explain this, and I like to present all three because different people maybe pick up on the concept a little bit differently. So hopefully, if you're listening to this, one of those three made sense to you. So Let's shift gears a little bit and drill down into the different types of investments, specifically within the DSTs. There are, as it relates to the debt, there's three kind of main categories that we talk about, or that investors will see on our platform. Can you give a quick background and overview of what those three are and how investors position those within a portfolio?
Yeah, of course. So I would say to start off, there are three main types of DSTs when it comes to debt. So there's going to be the debt-free projects where that property does not have any loan on it. It's going to be purchased all cash. So if you were to put $100,000 into that DST, you're really only buying $100,000 worth of real estate. There's also the leveraged DSTs. Those ones are the ones like we're talking about today. Typically somewhere between 40 to 55% loan to value. So those are typically going to be cash flowing assets where a portion of that loan will be assigned to you. You still get a cash flow off of your equity piece in that DST and then can pick up the debt you need. The third one, which is a bit more complicated sometimes, is going to be the zero coupon DST. So those are going to be DSTs that are leveraged anywhere from 80 to 90%, even high 70s. Those are typically not going to be cash flowing assets, but it does allow investors to pick up a large portion of their debt in just one asset. So, say you had somebody who had sold a property for $1 million. They had, say, a $600,000 loan on that property, so they only have $400,000 to work with. They could take $100,000 of the $400,000 that they have available, invest that into a zero coupon DST, pick up the $600,000 of debt in just that one property, and then with the remaining $300,000 that they have available, they could then put that into a debt-free DST to, de-risk their overall portfolio and get into, more conservative type investments. So the zero coupons, there are a few, nuances there on how they work, but it's a cool tool for certain investors that are looking to pick up a large portion of their debt in just one property rather than, diversifying across other leveraged assets.
Yeah, really well said. And I think one of the themes that we come back to with the DST structure is the flexibility that investors have to allocate specific amounts of equity differently to achieve diversification in their portfolio. And the diversification isn't just by the actual investment type or the location or even the sponsor company business plan. It can also be based on the debt structure. And there's a lot of different advantages and disadvantages to each approach, and we're not going to cover that on this call. But one of the things that I wanted to quickly focus on is kind of the typical way that investors approach the debt. So generally speaking, if an investor is debt-free, we're always going to encourage them to stay debt-free, right? One of the easiest ways you can mitigate downside risk is by not having debt.
Yep.
You eliminate foreclosure risk, protects your principal significantly. So for those investors that are debt-free, we're always going to encourage them to stay debt-free. For investors that have, say, a manageable, loan to value, and what I mean by that is anything, below 50%. For the most part, those investors are going to gravitate more towards what we would call the traditional leveraged DSTs, the ones that project a cash flow, typically, stabilized, cash flowing properties that have a specific business plan. There are instances like you described, Nick, where maybe you have a higher loan to value, or even not. The zero coupon can unlock some potential to replace a very significant amount of debt with a minimal amount of equity, but also allow investors to offload the debt, so to speak, requirement in their exchange to the one zero coupon asset to free up other equity for all cash assets or other leverage properties as well. So for those listening, I would say definitely reach out to your K Properties representative, because they can create different scenarios of what your situation could look like as it relates to the different options, that we're talking about here. And like I said, anything, there's always, pros and cons, But overall, we really would like to see our investors limit the amount of exposure to debt as one of the ways to protect their downside risk.
Yeah.
Is there anything else you would add to that, or anything else you want to say in closing before we wrap up?
Yeah, I mean, I think you definitely covered a lot of the aspects there. Debt in some cases could be good. In other cases, it does also increase your risk tolerance. So that's really why, at the end of the day, if we have investors that come to us with a certain loan balance, we really don't encourage that they pick up more loan than they need in the DST. We try to limit that. So that's why, going back to your diversification piece, why it's good to diversify and then, really match that loan dollar for dollar so that you're not increasing your overall risk by investing into DSTs.
Mm-hmm. Yeah, and another thing, to your point, just in closing, there are certainly advantages, to taking on debt as it relates to real estate investing in general. And to that, we always encourage investors, speak with your CPA, also speak with your registered representative to understand if that extra risk is appropriate given your risk profile. So that you can approach the situation eyes wide open, because there are some instances where it may make sense for an investor to take on a little bit of debt. Still, the default is we want to match the debt dollar for dollar or limit the amount of debt, in the equation. So I think we'll go ahead and wrap it up there, Nick. I appreciate your time, and thanks for all the insights you brought to the conversation.
Thanks, Matt.
Yeah,
appreciate you having me.
Absolutely. Yeah, and to our listeners, we appreciate your time as always. For more resources on this topic and other topics, please visit our website. That's kpi1031.com. Also, as we mentioned several times, please pick up the phone, reach out to your K Properties registered representative. Be happy to walk through your situation and dig into any of these concepts in more detail. So with that, thank you again for your time. Have a great rest of the day, and we look forward to speaking to each and every one of you very soon.
Visit us at www.1031.com for instant free access to exclusive investor resources, including our DST 1031 Exchange Book and the first ever 721 Up REIT book, written by our CEO and founder, Dwight K. You'll also find our Delaware Statutory Trust catalog and investor case studies. The K Properties team has helped over 4,000 investors nationwide, and we're here to help guide you every step of the way. If you'd like to connect with us directly, give us a call at 855-899-4597.